Hey, Jason Rogers here, and in this video I'm going to be talking about how we structured the capital stack, aka the financing, for our Nebraska deal. But first, another question I've been getting asked is, what have you learned from this process? What have you learned in having gone from goose egg, no business, no real idea of what you're doing, to securing a 7-figure deal, making it happen, closing it? What have you learned? A couple of things. One, people will doubt you. A lot of people will doubt you. Some of the closest people to you, in many cases, will doubt you. It just is what it is. It's honestly just because people get nervous. They don't know better, so they will worry, they will doubt you, they will question you repeatedly. So be ready for that. If you decide to start a business and grow it, perhaps via acquisition like we talk about here. That's number one. Secondly, I will share with you probably the most important skill set you can have in proving those non-believers wrong and getting your first deal done, and then moving on to subsequent deals and moving on to becoming a proficient operator in your industry. Probably the most important thing you can learn is the ability to stay certain that you will be successful in the long term, irrespective of how you feel, what you think, and what others say. Like I shared a minute ago, I had a lot of doubters, and you'll have a lot of doubters too. It's just part of the territory. Likewise, you will be overwhelmed, uncomfortable, uncertain. You will be doing things you've never done before. You will be put into new, novel, unknown situations repeatedly. It's your ability to still stay confident even amongst that uncertainty, and most importantly, to communicate certainty to your team, to your board, if you have a board, to bankers, to potential investors, to potential sellers. You need to stay certain. Easier said than done, but it's what goes on between the ears that's so important, and then what you say and speak into the marketplace that will have a huge impact. Because if you start doubting yourself, doubting the project, if you start not believing that you'll be successful, and if you start saying that you don't know if you'll be successful, your board will lose interest, your team will lose interest, sellers will lose interest, banks will lose interest, investors, if you need to go down that route, will lose interest. The wheels will fall off the cart. And then lastly, before we dive into the capital stack, I would say the third lesson I've learned is that if you need to raise equity, that raising equity is a lot easier to raise than debt, because equity is all about upside. Equity investors are looking for upside, whereas debt and bankers, they're trying to mitigate downside. In my conversations with a host of different bankers and investors alike, what I can tell you is that it's easier to communicate to investors than it is to communicate with bankers, by a long shot. We never had a tough time with equity in this deal. As a side note, in commercial real estate, it's pretty much impossible to do no money down deals. I'm sure some guy somewhere at some point did it, but as opposed to taking 5 years to try to do a no money down, all debt deal, we just, ultimately we have 12% equity in our deal, 88% seller finance, and we procured a $67,000 line of credit. I did, actually. That line of credit was the crown jewel of the whole capital stack. It's procured at 3.5%, which was a killer steal. But it's easier to get people to buy into your vision when they're interested in upside than it is to sell banks, because banks, irrespective of how successful your project is, will only get the principal plus the interest that you agree upon up front. And that's not going to be a huge interest rate unless if you get taken for a ride by the bank. But now I'll quickly talk about the bank financing, because that's probably the most difficult part. What I will say to you firstly is, we basically called, and when I say we, I mean myself and the individual who actually initially found the deal that I then negotiated with the seller. We called every single bank within about a 100-mile radius of the acquisition target itself. We called every bank. I called about 60 or 70% of the banks, and my partner, one of my business partners, called about the other 30%. From there, he and I, and mainly I, and he helped, aligned about 8 or 9, maybe 10 different bank meetings where basically we scheduled financial presentations where I presented. From those, let's call it 10 meetings. I really don't know exactly, but we'll just say 10, a simple number. From that, about 5 of them had considerable interest. About 5 of them didn't. From that point, and as a side note, some of the reasons they didn't have considerable interest is I didn't have a super high net worth or anything really remotely near it, especially when at the time, my net worth is higher now than it was then, right? So that was one reason why. You don't have enough net worth, young man. Another reason is, we're not comfortable with the asset class. But there were plenty of banks who were definitely giving us interest. There were about 5. Of those, there was one banker that I felt really confident we were going to do the deal with. I actually made this financial presentation. It was, I think, my 3rd or 4th financial presentation. And I'll never forget, he's the number 2 guy in the bank. It's a 5-branch bank, and he's a real decision maker, right? And we had our presentation, and I finished up, and I remember he looked at me and said, when we walked out of his office, he said, "Young man, I'm extremely excited about doing business with you, and I can't wait to be a part of this project." And he actually didn't call me young man, but it was almost like that like, "Hey guy, I'm extremely excited about this project and I can't wait to be a part of it." Something like that, I'm paraphrasing, but it was a very, very, very positive statement. And he immediately emailed me as soon as I left his office, and we were going back and forth. We're passing along the information he needs. We're getting along very well. And then just like that, he goes silent. And I'm thinking to myself, what happened? 2 days later, I get an email back from him. He says, "Jason, I'm so sorry, but we've been audited. I'm completely out of the count for the next 30 to 60 days. And so my main guy, he's gone." And as a side note, when you sign a PSA, you really only have, I think in our PSA, we had 90 days to execute the deal in full, right? So if he was off the grid for about 30 to 60 days, that pretty much meant he was out of the running. But because I was speaking to a host of other banks, I engaged with them. And long story short, there was one bank that was too conservative. There was one bank that wasn't comfortable with the asset class. There was one bank that just was having a tough time making a decision. And then there was one last bank that was really working out, besides the guy that had fallen off because he had gotten audited, right? So there was still one bank besides the guy that had gotten audited that was really pretty interested. And ultimately, he told me that he could do a $900,000 loan at a 6.25% interest rate on a 20-year amortization schedule on a 3-year balloon, which I was not super happy with. And I'll back up real quickly, because what we had initially articulated in the PSA was that we were going to procure a bank note of about $900,000, that the seller was going to assume a second position, match the interest rate of our first lien note on a 30-year AM 5-year note. And then, we were going to put about $100K in equity in. But that 3-year note I was really uncomfortable about. And at this point, the seller and I were building more rapport. He and I had a good relationship at this point. We happen to have a really good relationship now. I think, as a side note, one of the reasons why we have a good relationship and had at that point a good relationship is because I kept my word with him. I did what I said I would do, and I said what I would do, right? You do what you say and do it, and say what you do, right? We also got along well, which maybe was a positive impact. But ultimately, irrespective of the reason or reasons, I think he trusted me, and he's actually told me that he did and does. And I know he trusts me to a pretty substantial degree, because he came to me around that time when the bank was offering us that $900,000 loan, where the seller was then going to carry the $275,000 note, right? So most of our capital stack was coming together, but that first lien position note from the bank at 6.25% on the 20-year AM, it was a 3-year note. That's a 3-year balloon. That's pretty quick. And after 1 year of operations, you already got to start thinking about refinancing. Well, the seller came to me and said, "You know what? I'll make you an offer." And he did. He offered to assume a first position note of $1.125 million on a 20-year amortization schedule at 6% on a 5-year balloon, not 3, 5. And I accepted. I said yes. From there, we moved pretty quickly. I procured, I believe it's a $67,000 line of credit. I believe I talked about this earlier in the video, at a really low 3.5%, I believe it is, interest rate. which is what we're using as our overfinance, and we got the thing done. And so that's how we got our first deal done. What I would say to you again is it's the debt that's the most difficult part. For some of you, in different asset classes where maybe you're buying assets, businesses or real estate at only 3 or 4 or 5 times earnings, and generally speaking, you're not going to be able to buy real estate for that type of a valuation, but you will be able to buy certain types of businesses in certain industries at that valuation. There you may be able to only use commercial debt, but in commercial real estate, you're pretty much going to need to either have a net worth that you can deploy liquid cash into the down payment, or you're going to need to fundraise equity. But I wouldn't be terrified about fundraising equity. Fundraising equity, I can tell you, I'll make more videos about debt versus equity, but equity is all about selling the upside. Debt's all about mitigating downside. Debt's harder to sell because the banker wants to be certain that he's not going to not get his principal plus his interest back. So unless if you're going to a bank that's really hungry for business, it can be a bit more difficult to procure debt than it is, I would say, to procure equity. But ultimately, that's how we got the deal done. We're now on the hunt for other deals. We are only going to do deals that make a ton of sense, though. In the future, we'll probably only really be working with tenant-owned homes. And I won't go into the industry specifics of what we're doing, but we're really happy with our acquisition. We're really happy with how things have worked out. We can't wait to do more deals, but we're not going to rush, right? We really believe in the Warren Buffett, Charlie Munger principle that you want to buy great assets. You never want to get too jumpy to do a deal, right? You investigate before you invest. You really want to feel confident in what you're buying. You want to make sure that it fits into your company's scaling processes, that you're not overextending yourself so fast that you ultimately go bankrupt, because trust me, there's many businesses that have tried to grow through acquisition that have tried to scale too fast, and they haven't created economies of scale. They haven't had the right operational processes in play, and they've gone bankrupt. So we really want to make sure, obviously, that we scale on one end aggressively, but also pragmatically. This is actually the original thesis I have for Brighter Living, that we need to blend equal parts of aggression with pragmatism. And I believe if and when we continue to follow that thesis, we will be extremely successful in the future. So that's it in regards to our first deal. That's how we got it done. If you have more questions, share them below. If you've liked this video, thumbs it up. Helps me keep helping you. And again, any comments, questions, drop them below. If you haven't yet, subscribe to the YouTube channel. And if you're really looking for more content regarding how we're growing our business from scratch, I tell you in real time how we're doing it. And if you're interested in maybe me talking more about debt, seller finance, equity, or deal flow, these are different things we can talk about in subsequent videos. So let me know in the comments below, and I'll talk to you in the next one.